Good morning and welcome to the Post-Monetary Policy Committee press conference that is hosted by the Central Bank of Kenya. Yesterday was a Monetary Policy Committee meeting, out of which you received the press release that was sent out and also published on all our social media. As is customary, we are holding this press conference a day after, and how it will go is that the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, will address us, go through his presentation, and after that we'll be able to take questions. So if you want to send questions, please make sure you send your questions through Slido, S-L-I-D-O. The meeting code is #MPC01. Send your questions. Please make sure you let us know who you are and the institution that you represent. Without further ado, I'd like to introduce the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Thank you very much, Wallace, and good morning to all of you, wherever you are. Before launching into the business of the day, I want to wish each of you and your families a prosperous and safe 2021. We express our condolences to those that lost their loved ones over the last year, and remember those that have been adversely affected by the pandemic. We also remember with gratitude all those that have worked tirelessly to keep us safe and healthy. As was mentioned, the MPC met yesterday to assess developments since its last meeting in November 2020. And we will go through a few areas that in line with the deliberations of the MPC. You've already seen the outcome, and I will just put a bit of color as to the discussions and the issues that came up. The first pillar of this, of course, was the global developments. And as you are aware, there has been a surge of infections in the advanced economies, and imposition of containment measures in some countries, dampening the recovery that was gaining momentum since Q3 of 2020. There's also the complication of new variants of the virus. Against this, there is the welcome news of the rollout of vaccines. And of course, the policy stance in the advanced economies have remained accommodative. And the US yesterday obviously underscored that stance, and from their perspective also recently announced additional measures to support their vulnerable population, etc. Most recently, actually 2 days ago, the IMF updated its projections for 2021. It also gave it the first cut of 2020, which was a contraction in the global economy of 3.5%. And the projection for 2021 is growth of the global economy of 5.5%. Nevertheless, against this sort of improved outlook for 2021, it is clear that this decline that we saw in 2020 was unprecedented in terms of the global economy, and there are concerns that remain. First, the recovery is quite varied across countries and indeed across regions within countries. Secondly, there are emerging concerns about the dislocation of the financial markets, and with some risks there in terms of what this portends for future pricing of the markets, etc. So I'll move now to the external sector. And here the balance of payments, or the Kenya's external position, continues to improve, and remarkably so in 2020. Exports rebounded, growing by 3.3% in 2020 compared to 2019. And I think one of the most remarkable developments there is tea, with tea. there were increases in production. The volume is up in terms of production by something like 20.5%, and the value increased by 10.1%. Clearly, there were minimal disruptions in the tea sector, and we will talk a bit more about the agricultural sector in general. Horticulture exports also rebounded from July. They slowed in November and indeed accelerated in December. In terms of vegetables, which is one of the components of horticulture, the volume of vegetables increased by 59.6%, 59.6%. And the value is up 22.2%. This is, again, in the year 2020, the year of the pandemic. Flowers, of course, is another story. We are almost fully recovered. After the decline in the April-May segment, you can see it on your April-June segment, you can see it on the screen. Of course, we want to mention that the June numbers in 2019, there's that very large spike of 15,000 metric tons, and that related to problems that had emerged in a competitor, meaning another producer, one of the other economies that produces a lot of flowers, and they had some declines, and we moved in and increased our production appropriately. But you can see that we are now back again in a sort of more normal numbers. We should add that we have already done some survey on the flower sector. I'm not going to talk about it later, but I announced that it will be on our website in we expect to have it on our website by Monday next week. In any event, flowers also, looking forward, the next 4 months, in terms of orders, they look quite good. Also knowing that this is the peak season for flowers, meaning you have significant holidays and days. You know, you have Mother's Day, you have Valentine's Day coming up, you have Mother's Day, you have, I forget the other holiday, Women's Day, yes, absolutely. All of those are important in terms of flower exports, and as we have been told, the orders are virtually at the pre-COVID levels. I'll move then to imports, and on imports we recorded a decline of about 12.5%. This is in value terms in 2020, reflecting lower imports, oil imports. Actually, the decline was across all categories, all large categories. And so you have oil imports, for instance, it came down by 33.1%. In terms of value, US dollars, compared to 2019, our oil imports for 2020 were down 1.1 billion US dollars. So that was a significant, obviously this is a significant change, and we know that that relates to the much lower prices currently. Manufactured goods also were down 6.5%. However, there was a modest pickup in capital goods in the year, but importantly, intermediate goods, excluding oil, and in the second half of 2020. Remittances is another sort of bright spot for us in Kenya, and this remains strong throughout the year. We got an all-time high in December of US dollars 299.6 million. And for 2020 as a whole, this was also a record number of 3.1 billion US dollars, which is 10.7% higher than what it was in 2019. We'll talk. We'll mention something later in the year, but I mean later in the presentation. But I think you can see and appreciate the importance of remittances to our economy. Now, I won't say too much about the financial accounts, but I think there are significant developments looking forward that I would want to flag, and I'll come back to them. First is that there is market interest, a lot of interest in Kenya's portfolio investments, both in terms of government securities, and I'll say something about it later, and indeed the equity markets, which I'll also mention later. Secondly, there is expectation, or the government is moving towards reconfiguring its portfolio of external debt, which obviously will have some, let's say, action on the, or will lead to some, or will have consequences on the financing, as it were, of this debt. We have more to say about that later. Bottom line is that the current account deficit is now estimated at 4.8% in 2020 and is now projected at 5.1% in 2021. You can see that slide that shows the evolution of the current account. From 2014, it was 10.4. You can see it has come down to around 5%. Now it's 4.8 and 5.1. And we have made the point that we expect it to stabilize in the medium term around 5% of GDP. Against this, of course, the reserves, and currently they remain adequate. There is the number, the most recent numbers that were quoted in the communique, in the press release. But I wanted to also quote the level of reserves that we had when we closed the year 2020, and this was 7.750 million. So no, sorry, 7.750 billion US dollars, which corresponds to 4.76 months of imports. So that is adequate, and of course, against that, we expect, given the developments that we are expecting in 2021, the current account evolution, etc., we expect that the foreign exchange market will remain as it was, meaning stable, and meaning we will maintain the same stance and the same policy in terms of our exchange rate, freely flexible exchange rate, and will only intervene to minimize volatility. That has served Kenya well, and in particular in the context of the shocks that came in 2020. It's important to acknowledge the sort of, let's say, the pillars of our economic resilience, and one of which is a flexible exchange rate regime. Let's move now to the domestic economy. We have used the information that was available to us, Q1, Q2, leading indicators in Q3 and Q4. We had not seen the Q3 data that the Kenya National Bureau of Statistics released this morning. But I think the point here is that our leading indicators covered Q3 and indeed also Q4, and it was on that basis that we ended up having our conversation. I'll go through some of the sectors. Agriculture, for instance. And this has been performing exceptionally well. I think the projections that we have there on production, you can see in terms of tea production, etc., leading indicators. But there are other elements. We obviously have gone through the sector, looking at it, looking at the, let's say, product by product, detailed product by product outcomes. And I think the point here is that the agricultural sector has been a bright spot. Actually, we expect it to grow well above the average over the last few years. So this is a good year for agriculture, and that is 2020. And of course, we expect some of that dynamism to continue in 2021. Construction also has been very strong. January to November numbers, cement production, for instance, was 19.7% stronger, meaning that growth of 19.7% relative to January-November 2019. Obviously, this has implications on the building sector directly, and also if other things like sand, ballast, which are used in, you may say, proportion, in the correct proportions with cement, but also other things, doors, construction things, etc. So it shows significant dynamism in the construction sector. Manufacturing is an interesting one, and I want to mention it as we discussed it. First, we saw the leading indicators have been very strong. Yes, very strong leading indicators in the manufacturing sector. However, we saw that the numbers that are reported by the sector were quite low. And so there's a problem there. There is something needs to be aligned there. So what are the numbers that we looked at? First, credit. Credit has remained strong, credit to the manufacturing sector. Sales turnovers have also been very strong, very good. I just mentioned that there has been a pickup in the second half of 2020, pickup in imports of intermediate goods, which are being used for all sorts of things, to manufacture new things, whatever. Power consumption also have been strong, and this is a indicator that we look at very carefully. And we also know that earlier in the year there were problems in terms of the reporting of these numbers, but in any event, because of the shutdown, etc., Also, the general PMIs that were reported by one of the surveys that one of the banks does every now and then, all these point to a very dynamic manufacturing sector. We should also say that if agriculture is doing well, agro-processing would generally be also doing very well. And there are things there, we've also seen new, let's say, processing of mangoes, etc., that is taking place around the country, etc. So these indicators point to a very strong, or rather to a strong outcome, or strong outcomes in the manufacturing sector. However, as I said, the reported numbers, or some of the numbers reported by the sector of their performance, don't align themselves with this development. That's something, obviously, we and Kenya National Bureau of Statistics needs to look at a little more. But it is clear that, for instance, the numbers that are down would be things like soda production, beer production, because of the shutdown that was there. But those do not comprise 100% of manufacturing. So I think it is important to look at it that way as well. As a matter of fact, there has been new lines of production, and in particular PEPs, the masks, the protection material that, let's say, the health personnel are using, etc. So I think here is a case where we need to see exactly where the problem is in the reporting. It is clear that the problem, to us at least, the problem is on the reporting side. ICT sector has also been strong. There was significant strengthening. Not surprising considering what was happening in terms of people working from home, etc., more use of mobile phones, more use of mobile phones for even transactions, payments, etc., etc. But we've also seen that some of the numbers that are reported or that are used by KNBS do not fully capture the volumes correctly. And this is something also that we are looking at with them. But I think the point here is to just make the point, is to underscore that the ICT sector has been doing well, and we expect this to remain strong going forward. Two other sectors I want to mention, and then I want to flag and then leave it. Accommodation and restaurants. This, again, we have a survey of hotels which will be put out on our website on Monday. But it shows of the 97% of respondents have reopened their sectors, and you can see it there. Now, this one differentiates the location of the hotels, the ones that are in Nairobi and then the rest of the country. And you can see the ones elsewhere in the country, virtually all of them are open. In Nairobi, there are some that are not open, but I think the numbers are high now, so we can. The problem, though, is the average bed occupancy. This, even though it has increased since the doldrums of April, this remains low at around 26% overall. And I think this is something that obviously we are looking at, meaning the sector is concerned about this. But again, for the tourists to come, the hotels have to be open. And I would also underscore that the tourist sector, the hotel sector, did get significant accommodation by the financial sector, the banking sector, in terms of restructuring their loans, etc. And the expectation there is that it would also help them maintain their workforce. Maybe not at full salary, but at a modest amount, so that they can reopen strong and, in a sense, hit the ground running. The other sector I want to flag is the education sector. This, I think, the issue here is a change in methodology by KNBS in terms of how they capture the real production in the sector. Now, so the numbers are low because the students or learners were at home for most of 2020. Now, obviously, towards the end of 2020 and through 2021, those numbers will move back to pre-COVID levels, and therefore you would expect a sort of a normalization of the sector. Obviously, we hope that the COVID issues are taken care of in the schools, and indeed that they remain safe in the learning institutions that they are in. So what's the bottom line here? I think the bottom line is that we expect modest growth in 2020, meaning that's what we should have, but a strong recovery in 2021, driven by agriculture, construction, manufacturing, etc. So in a sense, the dark days of 2020 and with the reopening of the economy, with the dynamism and the momentum that is being gained in those dynamic sectors, we expect that this will push us strongly into 2021. Just one word about inflation. I think this is the point I would mention. Inflation remains low and well anchored. There's a slide about inflation if you want to, there it is. It's a very busy slide. I didn't quite like it, but there it is. But you can see inflation now is at about 5.6%. That's the headline inflation, overall inflation. And this is, of course, for November. We don't, for December. We don't have the January number. However, you can see the various components, non-food, non-fuel, that's the green one, remains low. Actually, it has remained below 3% for more than a year. Also, in terms of food, that's the blue one. It's now at 7.2. But you can see it's really come down from the peak that we had in late 2019. If you remember 2019, the price dynamics in the food sector were driven, the food sector were driven by the drought that we were suffering at the time. So that's when you had these very large increases in prices, but now we are back again in the lower numbers, obviously in the single digits. So we expect the prices, overall prices, to remain anchored and definitely to remain within the target band that we have, which is 5% plus or minus 2.5%. I want to say a few things about the banking sector, if you may. And I think here, as always, we are concerned and we watch the banking sector carefully. The sector is stable and resilient with adequate capital, etc. Liquidity also is adequate and well distributed. And the only point to mention here is credit risk remains elevated. And we've been making this point throughout the last, for quite some time. And that is expected given where the economy is. Now, NPL ratio to gross loans, that has increased to 14.1% in December, or it is now at December, it stood at 14.1%. And yes, the question is, okay, so now with all the changes in the economy, where do we see this number surging? And is this really something that you could say is out of control? And the answer is no. We have done some scenario analysis, the what if kind of scenario. And really, if assuming that, and these are assumptions, right? Assuming that the economy remains flat, meaning the dynamism that I was talking about a moment ago does not reveal itself. Also, assuming that the benefits of the reopening do not come through, meaning you are holding the economy sort of at its worst. If that continued, let's say, for another 3 months, we've calculated that NPLs obviously would rise, and we have calculated that this would rise maybe to 16 or 17% of gross loans. Those numbers are still manageable. Why are they still manageable? Because, as a matter of fact, banks have been doing what they needed to do. Meaning they needed to be conservative and make provisions for their loans. And in this regard, if indeed you thought of the NPLs that we have at this moment and included, or rather excluded, the provisions that banks have already made, that number would be something like 5.7% of gross loans. So you can see, and that has actually remained fairly stable from about 5.6 earlier in the year, from March. We are talking now 2020. So you can see that actually banks have been prudent they've been doing what they should be doing, managing prudently their loans, working with the borrowers, but at the same time, arranging their asset position so as to provide for any potential losses. That, I think, is the point to mention. Of course, the measures, the emergency measures that we put in place have also been beneficial. We've talked about that in earlier discussions. But I think the point I would also emphasize here is that looking forward, the banks will be central, will be key in the outcomes, the positive outcomes that we will see in 2021. And in this regard, we've looked at some of the early numbers, and we are confident that they actually stand ready to work with the customers. And one of the reasons why we are confident about this is because we've had a rather detailed exercise with each one of the banks. And this is their internal capital adequacy assessment plans, ICAPs, as we call them. And we have been holding discussions with them. As a matter of fact, in this context, and also in the context of the COVID-19 scenario, banks have had extensive discussions one-on-one with their own clients and ended up understanding their clients a lot more. So in a sense, you could say this has been one of the, let's say, positive windfall benefits from the situation that we have been in 2020, that banks now know their customers, understand the business models of their customers a lot more, instead of having some sort of generic cookie cutter approach, and therefore can price the loans to each customer individually, as opposed to having a cookie cutter approach to things. So these are all benefits, including, of course, their acceleration of digitalization, etc., expansion of delivery channels, etc. These have all been positive things. I would also add that from a point of view of the bank's relationship with the customers, a key area that obviously is of concern is the SMEs. And this they have been working. As a matter of fact, a lot of our banks have been making progress in their new products or new sort of energy, putting new people, etc., in the area of SMEs, the relationship with SMEs. Banks have realized that going forward, the game in town is SMEs. But at the same time, there's also the other side, which is the credit guarantee scheme, which will be beneficial to the SMEs. And this has now been launched and is being made operational as we speak. So that's all I wanted to say about the banking sector. I have a few more points before I finish, and I apologize for being a bit taking a bit more time than I was expecting. I think there are a few points I'd want to mention here, which is at the same time in the context of the meeting, we did look at the fiscal position and noted some strengthening right at the end of 2020, particularly December revenues, etc. But I think what we want to mention here, the significant thing here, is that the government continues to work on the economic recovery plan. And as part of that, yes, it will require some strengthening of their fiscal position, not just taxes, but also expenditures, and in a sense to anchor their fiscal strengthening on to anchor it credibly on some sort of medium-term basis. But there are a couple of things I wanted to mention here. First, one of the elements in terms of fiscal is an element that the benefits that are coming from the debt suspension initiative that the G20 has provided to Kenya. And basically, in terms of numbers, now I'll give you the US dollars numbers, but we can work on the Kenya shilling ones, but let's work with the US dollars for a minute. So on US dollars is something like 600 million US dollars are falling due, or let's say are tagged by the G20 and indeed the wider G20, including of course China, the non-Paris Club. So something like 600 million US dollars, right? And this is all what is falling due between January 1 to June 30th. Now of this, about 378 is falling due to China. So you can say it's about 2/3 of this amount. So yes, we did get the Paris Club component, and that was announced, and there was a press release that was also issued. Actually, press releases, 2 press releases, one by the National Treasury and the other one obviously by the Paris Club. And also the PS, the Cabinet Secretary also announced that we had got confirmation from the Chinese authorities of similar treatment of the loans that are due to them. So in a sense, we will have a delay of, or we'll consolidate the payments that are falling due to these creditors between January 1 and June 30th. They'll be consolidated and repaid over 5 years. Repayment over 5 years with 1 year grace. So that is really the arrangement. Now, we should add that the G20 they have committed to consider if they could extend the DSSI beyond June 2021. And that will be, they'll consider it in April in the context of the IMF World Bank spring meetings. Of course, there'll be other actions as well, further action to reprofile the government of Kenya external debt, and that is something that obviously has been announced and is something that will be looked at going forward as circumstances allow. Also, we'll make the point that, now the last 2 points. We will be having a remittances survey. We made the announcement on this in the month of February and March. And the point here is to actually understand better where from, how the remittances are used, what channels are used, so that we can facilitate their increase. As you can see, they are significant, as I mentioned before. So that is something that we will look at, and it's already been made public, and you'll be involved in it in various ways. Finally, the way we see things, we entered 2021, or rather we have now entered 2021 with minimal, or should we say, with minimal buffers. The buffers were eroded during 2020. A lot of, and here I'm talking largely from the perspective of the private sector actors and private households, etc. But it's not just the households that have minimal buffers. Even the government, even all, let's say, policymakers. Yes, it is good to acknowledge that the buffers that were there, let's say in 2020, when we entered January 2020, have been eroded through correct action to address the shock, the COVID-19 shock that we got. But this makes building back tougher and more risky. That is the point I would want to make. And therefore, we need to be much more efficient in the use of the resources that are provided to us, or the buffers that we still have. It means also we need to strengthen the weak points that are emerging. We need to bring about a soft landing of the economy going forward. And this is a bit tricky, as I said, because there are less buffers. But I think this is really what we as policymakers are focused on. From my perspective, there's one element which we need to watch carefully, which is the operation of the markets. The markets need to remain fully functional. And I think the ones I would mention is the debt market. By the way, there may be a slide there that you want to show us, the one about the yield curve, if it is with you. Yes, so this is the government security yield curve, and the current one is the green one. You can see that from 2016, the dotted line, it moved to the black line, and then the green line. You can see it is sort of adjusting to become a more normal yield curve. And I think this is one of the things, one of the pluses, that even in 2020, the yield curve remained appropriate. And this is something that ensures that the debt market remains operational. The money market, as I said, also has remained well, has functioned well. And indeed, the FX market, the foreign exchange market has also remained fully functional. So I want to stop it here and take your questions, please.
That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. We will jump straight into questions, and I want to begin with the first two. The first one is from Kefa. I believe this is Kefa Moirori from Radio Citizen. He asks, is a governor concerned over borrowers' risk as NPLs trend upwards? Should we expect an extended window to restructure loans as cushioning to banks after March? Second question is from Alan Aoko of KBC. He asks, the private sector insists that they still slow private sector credit growth. What are the bank's projections, especially as we see a jump in digital lending?
Okay, thank you very much, Wallace. I think on the first one, I already answered that about risks from NPLs trending upwards. I explained that we have looked at this and run scenarios. So in a rather extreme circumstance, where we hold things at the lowest level, how would things look, let's say 3 months, 4 months forward? And I think the point there is that we see that the levels obviously will rise, but we believe that that is manageable. So we don't see any, let's say, dynamic emerging, negative dynamics that would emerge to cause significant concerns there, because we believe the numbers that are quoted are manageable by commercial banks. Of course, one could make the point that that is an extreme scenario, the one I talked about, and the economy, really the part about where the economy is going, the domestic economy, points to continued momentum and indeed economic dynamism. So one can make the point that maybe our assumptions were extreme, but I think the point here is that we have looked at it and the numbers look appropriate. The second question is about the private sector credit. I like this. Private sector insists. I would make the point that one of the issues that we need to see is, let's use data. Let's use actual data. I don't know about insisting. So what does the data show? what is the private sector credit growth for December? The number we have is 8.4. 8.4 for December. I believe that's the number. Could somebody? Yes, it is 8.4 for December. See, I even remember it. So I think the point there, and this is obviously a significant recovery. So in the context of COVID-19, the private sector credit growth has increased to that level. So I don't see much concern. Of course, we have the digital lending, etc. These are channels. These are channels for providing credit. They do not substitute credit. They're just channels. So they make the providing of credit more efficient, maybe in terms of quantum, etc. So it is more that, or timing, so the anytime, anywhere sort of outcomes. So I think this is actually beneficial to our economy, and we should be going there. After all, we should be going to a 24/7 economy.
All right, thank you, Governor. The second batch of questions, I'll begin with Dennis Otieno from Citizen Television. He asks, the KNBS report shows the economy contracted in Q3 of 2020. Would this amount to recession, and what is the impact? Second question from David Herbling of Bloomberg News. How much is planned in the switching of short-term domestic debt to longer-term domestic debt with the aim of lengthening the maturity structure? Third question, Franklin Sunday from Standard. The governor has indicated that some numbers from the manufacturing and ICT sectors are understated. What is the margin of difference compared to CBK figures? Finally, Victor Amadala from The Star. Is the IMF's demand that state agencies' loans and pending bills form part of public debt valid?
Okay. Okay, let's take the questions one by one. I haven't looked at the numbers that were released this morning. I already stated that before. So let's look at the numbers. All I said is that we did look at various lending leading indicators, and the leading indicators pointed in the direction that I mentioned. I also made the point that there has been some, let's say, disparities in with some data, and I pointed out those sectors. It means we have work to do. I don't think this is something that we could sort of gloss over, sort of over 10 minutes or whatever. It requires going back, understanding why those numbers or those reports are the ones that are used, et cetera, et cetera. So I think we are pointing to work that needs to be done. So I leave, so that's how I would answer the question by Dennis. And indeed, the question by Franklin, whoever it is, I don't know who it was, Franklin Sunday, I think, about the numbers between the differences that, or understatement of numbers. I don't want to use the word understatement because I haven't, I mean, you'd ask me, okay, who has understated it? Is it KNBS? Is it ourselves? Is it? I don't want to get into that sort of discussion. All I'm saying is that those numbers have formed, the ones that I mentioned are at variance with others that have generally been used to indicate where the economy is, and we need to align them going forward. The question about planned switching of short-term debt to long-term debt with the aim of lengthening. I don't think, anyway, maybe to answer the question, first, where are we? And I want to quote some numbers so that we can be on the same page, right? If you'd excuse me for just a minute. So I think it is important to say that one of the targets of targets that we had of a year ago was actually lengthening the maturity of the average term to maturity of securities, government securities. And at the same time, reducing the dependency on T-bills. Treasury bills were really meant to be liquidity management instruments, not for long-term financing of the government projects, etc. So that is the thing. So in effect, we have, and this is an objective that is there and has to be done, let's say, incrementary. And today, the debt maturity profile has lengthened. The average time to maturity for treasury bonds has gone to, is now in January, is at 8.5 years. And this is up from 7.96. So somebody wanted to say 8 months, but anyway, whatever it is, 7.96 in January of January of 2020. And indeed, in January of 2019, this was down at 7.09 years. So you can see January 2019, it was 7.09, lengthened to 7.96, and now it is 8.5 years, January of 2021. I think that's remarkable performance. Also, in terms of dependency of reliance, as it were, on the T-bills, the ratio of T-bills to T-bonds has fallen. It now stands around 23%, 23 to 77%. I don't remember the number earlier, but that is anyway, we can give it to you. It's actually somewhere in our public documents somewhere. So I think it is important to appreciate what has been going on, including during 2020. So there is no target as such in terms of, I can tell you we want to be here by the end of the fiscal year or the end of the calendar year, or whatever else it is. I think we are taking advantage, because remember, it's a market. So we are taking advantage of the situation in the market, meaning the appetite of the market makers. But I think the most important point here is to make sure that the market operates correctly, pricing correctly, and indeed there are no shocks that have been introduced. And then the last point was IMF demands. I don't understand this question, so I leave it. I don't know what IMF demands are. Whenever we do things with the IMF, or anyone, we have to do it at our own pace and our own, if we want to do something, we do it. It's not that the IMF should tell us what to do or what not to do. So I don't know what this demand is. State loans and pending bills, I think we've made this point before. And maybe you should give us credit for it. And I'm talking now mainly about the National Treasury and ourselves. The whole point of the pending bills. From our perspective, we have made the point that pending bills are really destructive. They really ruin pricing. They also ruin the operations of the financial system. So this is one of the reasons why it is important to honor your claims. And the problem isn't just the government. The problem has also been the private sector. There are elements in the private sector that are not paying other elements in the private sector. And so that is a matter that should be dealt with, once and for all.
We shall go with the last batch of questions. The first one from Duncan of Reuters, I believe, has been answered. And he is speaking about the reprofiling of the government's debt. The two that are substantive is from Stephen Kimani of Metropole TV. He's asking, with rising NPLs, those are non-performing loans, and more than half of loans restructured, is the CBK confident that our banks are robust? And the final question is CBK still pricing in the possibility of a second wave of COVID infections or the return to lockdowns? And what might that do to Kenya's economy? That was from David Habling of Bloomberg News.
Okay, so the first thing, I think I explained myself where we stand in terms of the NPLs. I explained where they are as in December and relative to where they were in end October. I explained where we expect them to go in an adverse sort of scenario. So I think that, and I've also explained that the banks have adequate buffers to deal with those shocks. By the way, one of the things that we did, and we announced this, was to remind the banks to be prudent in their decision with regard to dividend, etc. And they have, as I have mentioned, they've actually been also prudent in terms of how they provide for potential losses due to non-performing loans, etc. So I think you can say that within the limits of our instruments, we are confident that we are looking at the things. I mean, I think that's the way we need to. Nobody has a crystal ball to figure out where things will be. But the question is, have we used the instruments that we have, standard instruments in the sector, in the field, to understand or to understand that the sector can handle a significant shock appropriately. So I think, Stephen, I've answered your question. The question about CBK pricing, I don't know now what this really, what do you mean by pricing? CBK is still pricing. This is technical. It sounds great, but I don't know what it means in reality. You ask the markets when the markets are working in this area. But of course, as I said earlier, there is this second wave that has come in the advanced economies, and that has direct implications to us, in particular in the accommodation or the hotel, the industry, etc. We've also seen that our flights have been canceled or we are not flying to some of those countries in Europe and the UK. But I think the point here is that we are not blindly assuming that this problem is just we are wishing it away. We cannot wish away problems. We have to deal with them. And I think that's the mark of, let's say, mature decision making by the private sector, by policymakers, by everyone that is involved in this business.
Thank you very much, and that brings us neatly to the end of this press briefing. It was a press briefing for January 2021, the post-MPC press briefing from the Central Bank of Kenya. As is usual, please keep tabs on all our channels, social media channels, and also look at your communication for any communication from the Central Bank of Kenya. But without further ado, we expect to see you again after the next Monetary Policy Committee, which is scheduled for March. But if anything happens, we will let you know way before then. Thank you and good afternoon.